Happy Sunday. So what's everybody buying tomorrow? I just saw Nvidia got downgraded, right? By somebody. Nvidia downgrade. I didn't really look into that. Nvidia stock is a downgrade as AMD Taiwan shares are deemed top plays. Huh. Did you guys look? Hey, Chris. It's so like, I feel like, remember when Trump got elected and the first, when he got elected president, people were saying, I hope he fails. I hope he does a terrible job. But it's kind of like saying, it's like rooting against your country. I feel like that with Nvidia. When I hope Nvidia stock, crashes and does really poorly, I'm kind of rooting against myself because I have a lot invested in the S&P 500. And the reason that's doing so well, the main reason it's doing so well, that investment, is because of Nvidia. So if I hope Nvidia goes down, I'm kind of like saying, I hope my stock portfolio goes down, which doesn't make sense, right? Louis Vuitton, MSCI, the stock exchange, MSCI. I'm looking into TELUS. Tell us more about TELUS. TELUS is like the T-Mobile of Canada. Is that a good way to describe them to Americans? TELUS is like buying valet. You ever watch videos and people mispronounce names? They call valet Vale. And, we all make mistakes. I've made a lot of mistakes on my channel. But when you listen to somebody give you financial advice and they call a company valet Vale, and when they're talking about REITs, they say REIT instead of REIT. I would question whether that person really knows what they're talking about. Probably not somebody you want to take advice from. Just my opinion on that. But predictable free cash flow with strong capital return. Take a look when you have the chance. Strong moat. Freddie. Yeah, Louis Vuitton. Moet. Is that? That's, the guy who owns Louis Vuitton is like the richest person in the world, or top 3. Wait, what do you mean? My last community post. Oh, where against my peers? Oh, okay. You mean you want to see like the results of that? I'm just curious. Like, when I write these posts, I'm just curious, like other people, and this is obviously an opinion. So how would you rate your financial situation? There are some people who would say they're a 9 or 10, who aren't doing that well. So it's kind of perspective. It's like, it's how you view things. And some people would rate themselves a 1 or 2 and are actually doing pretty well because they're just very hard on themselves. So I learned my investment style from Bill Ackman and Terry Smith. Let me know if you want to discuss more. Yeah, I like Bill Ackman a lot. Pershing Square. I've been following him for a long time. I think if anybody says they're a 10, I just don't think many people are a 10. If you're a 10, you're like in the top 1%. And I'm doing this based on age. So if you're like 20 years old and have $100,000 saved, you're probably like a 9. Maybe you will be a 10. But if you're 60 and have $100,000 saved, you're probably like a 3. But it's perspective, like I said. So if you live in like LA or Chicago or like a big city and you have 100,000 saved, you're probably not crushing it. But if you live in like maybe a country that's a low income country and you have $100,000, the equivalent of 100,000 US, you might be doing like amazing. So it's very Bill Hell is coming, Spackman. Is there a popular YouTube video going around called The Growing Hatred for Financial Influencers? It's about guys like Graham Stephan. I don't know. That's the growing hatred of. I could see why people would make a video like that. The growing hatred for financial influencers. It's a good way to get views to make a video like that. I'm definitely gonna. Everybody gets jealous. If you're successful, there's going to be a good amount of people that will hate you.
Lately, I've noticed my perception of finance YouTubers slowly shifting from educational resource to scammy salesman. And I'm not the only one that thinks this.
Financial YouTubers are a cancer. Time and time again, they keep getting away with shilling terrible advice.
Yeah, it's hard to play this video on a live stream. Hey, David. Yeah, I'm definitely going to watch that. But Nvidia. Okay, Wall Street analysts are bullish Nvidia stock, but the pack of analysts standing on the sidelines got a tiny bit larger on Friday. Nvidia shares down 2%. Upside will only materialize in a bull case in which the outlook beyond 2025 increases materially. He notes that consensus projections imply 35% growth in revenue. Shares of Nvidia. He remains bullish on AI names, Taiwan Semiconductor. I thought it was about the downgrade. I don't see. It doesn't really. What does he mean downgrade? I guess it wasn't a downgrade by a rating agency. It was just a downgrade by some guy. Nvidia gets rare Wall Street downgrade. Come on. Investing.com. Okay. Okay. Here is your pro recap on the top takeaways from Wall Street analysts the past week, including a rare Nvidia stock downgrade. What happened? On Monday, Goldman Sachs upgraded ICE. That's the stock exchange, Intercontinental Exchange. I did a video on ICE. I got really, really close to the stock price to a buy to 167 target. What's the full story? Goldman upgrades ICE to neutral. Okay, where's Nvidia? I thought there was an Nvidia downgrade. What happened? Okay. On Friday, New Street Research downgraded Nvidia to neutral with a 135 price target. 135 price target from 125. So it's not a, or maybe they had it at 150 and brought it down to 135. Nvidia. It's the same thing. Remember with Tesla, if you weren't in Tesla, you weren't doing well. It's like if you're not in Nvidia, but if you own the S&P 500, which I think probably a lot of people do, you're in Nvidia. So what's the full story? Okay, New Street's analysis indicates that consensus expectations suggest a robust 35% increase in GPU revenues by 2025, aligning closely with their earlier forecasts leading into earnings. However, the brokerage perceives limited potential for further upside, citing insights gathered from the industry value chain. Consequently, New Street downgrades the stock to neutral, emphasizing that significant additional gains would depend on a bullish scenario where the post-2025 prospects notably improve. Okay. Looking ahead, projections anticipate a deceleration in revenue growth to the mid-teens. I mean, it's got to come back. There's no, I mean, they're growing too fast. It's like a 4x growth from like 23 to 24. So obviously you can't grow at that pace. Currently trading at 40x next 12 months. And the thing is, when you're successful, competition will come. And they already have competition. AMD is a big one. But there's already companies that are already present that have built plenty of semiconductor chips already. So competition's there. New Street values Nvidia at 35x. I would really like to chat with you privately about stocks more. You can reach F for finance. Well, if you want to talk, you could do it on a live stream. We could talk. We can talk openly. That's the best way. We could do it right now if you want to. If you want to talk right now, or anybody wants to. You don't even have to talk. You can just sit there. If anybody wants to co-host a live stream, you could do it right now. Click on this link, and I'll allow you to come in. JB Weld, thank you. Always so generous. How did the stock react? Nvidia's opened the regular session at 127, closed at 125, declined at 2%. Can a REIT set up a holdco, buy shares of their own company with the holdco, and bypass a 90% distribution rule that way? No. I mean, a REIT, like the people who start the REIT, they could invest in it and own part of the company, and therefore they would be receiving dividends. But it's just like a law. It's a rule. I'll show you. I actually was just talking about this on the video I did. Like legally, they have to distribute at least 90% of their pre-tax income as dividends. So if you want to be a REIT, you have to follow these rules. You have to invest in 75% of your assets must be in real estate. You have to have 75% of your income from rents or interest, because there's mortgage REITs who don't own any property, but they just lend money to people who are buying real estate. But another thing that that you can't circumvent is that let me just bring this into Excel. So if you wanted to create a REIT, which we should do, all of us can do it. If you guys want to, think about developing a real estate hedge fund, and then we could turn it into a REIT. So if you so a REIT is like a mutual fund. It's very similar. So the purpose of a mutual fund is you issue stock or shares in the mutual fund, and people buy the shares, and then the mutual fund takes that money and buys stocks or bonds or whatever asset they buy, and it's just a pool of money to work with. So a REIT is the same thing. You might have like, 1 million investors, and say the average person invests $100 into your REIT. So you have $100 million to work with. And then if you're a regular equity REIT, then you just buy real estate and fix it up and then rent it out. And then the rental income will pay dividends to your shareholders. But another thing, I think some of you guys know this. A REIT has to pay 90% of its taxable income as dividends. But another thing is a REIT cannot have a lot of concentration in the shareholders. So no more than 50% of the shares owned by five people. So you can't have somebody who owns 70% of the company. You can't even have, if somebody owns 40% of the shares, one person, and another person owns 8% of the shares, another person owns 5%, you can't even do that either, because no more than 50% of its shares held by 5 or fewer people. So if the top 5 shareholders of your company look like this, say the top 5 shareholders look like this, it would not qualify as a REIT, because top 5 own 56% of the company. But if the top 5 shareholders look like this, then it's fine. One person owns 40, the second 3, etc. So buying C-Box, UK company, you should take a look into that. Alex, what's up? Can a REIT set up a holdco, buy shares of their own company with the holdco and bypass? Yeah, it's always surprising to see how bad a company is doing until you kind of look beneath the hood of the car. I mean, it's just a dying, fledgling company. It's a good short if you want to short it. I mean, you could set up a holdco and buy shares in a REIT. In your REIT, I mean, you can't buy more than 50% of the shares, but you can buy set up an entity to buy like 10% of the REIT's stock, but you still are going to receive those dividends. The only way the REIT could get away from paying dividends is if it doesn't make any money. If it's losing money, if there's no taxable income, then it can't give a dividend. So that's the only way to get around it. But so it makes it really hard for the REIT to grow when you only have 10% to invest in back into your business. That's why a lot of companies, when they start out, they don't pay a dividend even when they're profitable. Like Meta just paid a dividend, but they were making like, what was it, like $30 billion of profit a quarter for several quarters, but they were not paying a dividend, because a lot of, especially tech companies, do not pay a dividend. They reinvest the money back into the company, and usually they reinvest it by buying other companies, or if they're like a rock star like Apple, they just reinvest back into their own company and build more factories, spend more money in R&D to like come out with a self-driving car. But a REIT, you pay higher taxes. That's a setback. You pay ordinary income tax, so it's like you might pay 35% tax rate on your dividends. Apple just blew $100 billion. They buy back a lot of stock. It's such a good investment, stock buybacks, because if you give $100 billion of dividends, you can't get that money back because it left the company, right? If you pay dividends to your shareholders, you can't ask for that money back. It's gone. But when you buy back stock, you can just then sell stock if you need money. Like that $100 billion of buybacks. Say they need $100 billion, like in the next quarter, then they could just issue $100 billion of stock, right? I mean, the only negative is say you bought back $1 billion of your own stock, right? And let's just say each share was trading at, this is the only negative, total buyback share. So one share is is 175. So shares bought. So that means they would have to so let's just say in 2024, a company bought back $1 billion. They spent $1 billion on buybacks, and each share was 175 when they did that. So they would 5.7 million shares they're taking off the market and putting it onto their balance sheet, which is good for shareholders because then the remaining shares go up because there's less shares to spread the money around. So everything improves, dividends improve. And let's just say the following year they needed $1 billion and they didn't want to issue debt, so they have to issue $1 billion of stock, right? But the only setback is if the stock price is higher. Say it goes up to 225. Now they can only issue. They're issuing 4.4 million shares to get that. No, sorry, that's a good thing actually. If the stock price is higher, then it benefits the company. But if the stock price goes down, say it goes down to 125, now they have to issue 8 million shares to get that $1 billion. Where when they bought back the shares, they only had to they bought back 5.7 million. So they're doing more dilution. But I know some of these terms can be confusing, but think of it, because especially with big numbers, but think of it in the same respect as you as an investor. Say in 2024, you want to spend $10,000 on a company stock. Well, okay. I don't want to sound confused. Okay. So buying back stock is great when the stock price is low. Same thing when you buy stock. you want to buy it when it's low. So if you put 10K into Nvidia when Nvidia was $50 a share, that's great, right? Because it's so much higher now. But if you didn't buy it when it was $50 a share, and now it's, well, now because they did stock splits, so it's a little harder to do, but now it's 150. You were much better off buying it, the stock at 50. So same thing with a company, when they buy back stock, they want to buy it when it's cheap. And when they issue stock, they want to issue the stock when it's really high and inflated. Like when a stock is trading at its all-time high, that's the best time to issue shares. But like if you see a company, what was it like? Was Kodak? Like they filed for bankruptcy, and then the stock price, they got a lot of action with the stock price. So then they wanted to issue more shares. Buying C-Box, UK company, C-Box. So when a company, a negative, well, people think it's a negative. When a company buys back another company, or buys back their own stock, then investors feel that they have there's no other ways for them to make money. Like, why don't they try to buy another company or build their own, build another factory or something? Why do they have to buy back stock? So that's the perception when a company spends so much in buybacks. Come on. There's the idea is that they don't have any other they don't have much going on, which may be true. Most investors see a buyback as a positive thing, but you don't. The whole reason you invest in a company is so they grow their business and become more profitable, not so they buy back their company, right? But it's a balance, if they're. I have notes on everything in my phone. Every time I learn something new, or I put in my phone. So I must have like thousands of notes. So here are all my notes on buybacks. Okay. Especially when I'm making videos, sometimes I want to say things concisely. So I may, I try to write it and keep writing it in different ways and saying it differently. But let's go through the notes on buybacks. I think it's good to understand this stuff. And if anybody ever wants, what happened? If I ever talk about something on a live stream and you want, I could you want me to send you that file, just email me and most files I can just send it to you. If there's a topic, especially if something I'm talking about that's confusing, Yeah, I think buybacks are great. I used to think buybacks weren't good till I understood how they worked. Okay, so these are my notes on buybacks. Okay, so when a company buys its common stock, those shares are taken off the market and put onto the company's balance sheet. So hopefully the company created in their equity section, they have a line item called treasury stock. This should be all the buybacks are put into that category, treasury stock. Some companies don't have treasury stock, and I think I mentioned it, which I wish they would. Right, I say it right here. So when a company buys its common stock, the show shares taken off the market, carried on the balance sheet as treasury stock, or it's a reduction of retained earnings, or they reduce their retained earnings. So you can't really tell how much they bought back if they don't have treasury stock, which is a little annoying. And let me know if anything's not clear, because I know some of this stuff isn't super straightforward. So now, if a company reissues the treasury stock, so say a company bought one share, which they wouldn't do, but they bought back one share at $200, right? And let's say 6 months later, they wanted to reissue that share into the open market. So if a company reissues a treasury stock at a profit, meaning they bought it for 200, so that's a negative 200 because their cash goes down 200, and their treasury stock goes up. Treasury stock is a contra equity account. So when treasury stock goes up, equity goes down. So let's just pretend they issued the treasury stock at a profit. Now that share they bought for $200, now one share, now they can issue it for $250 because stock price went up. It went up by $50, right? So then on a company's balance sheet, they'll increase additional paid in capital $50 because they have to account for the $50 somewhere, right? Because when a company reissues those shares for $250, cash goes up $250, right? And then you have to raise your equity $250. JB, thank you. So generous. Altria recently sold a large stake in InBev. Yeah, InBev, AB InBev. Then used the proceeds to buy back shares. The income they were getting from InBev was less than the amount they were paying in most shares. Dividends aren't on the balance sheet. The only time you'll see dividends if it's dividends payable, which are dividends the company will pay in the future, like when they announce a dividend payment. But dividends are cash items, so they'll show up on the statement of cash flows in the financing section of the statement of cash flows, but they're not on the balance sheet. I guess the dividend is the cash. That's where they get the money to pay the dividends from, the cash, the asset section. We'll talk about TRIA. And a third scenario, if a company reissues a treasury stock at a loss, the difference is debited to additional paid in capital. So additional paid in capital, if you watch my video on connecting the financial statements, I go through how a company records like the issuing of stock. When a company goes public, I show you in that video where they put the money for the sale of stock. Obviously, they get cash, so they put it in cash, and then they record in the equity section. Additional paid in capital is how much a company made from issuing stock. So if you look on a company's balance sheet, that tells you how much money they profited or made from issuing stock. But if additional paid in capital, say there was only like in this example, say before they issued the stock, there was $25 of additional paid in capital on the balance sheet. And remember, a company bought back one share for $200, so their cash went down 200, equity went down 200, and then the following year they issued this share, but the stock price went down. In this case, it went down to 150, so they lost $50 on this share. So how do they record that $50 decrease? Well, they can't decrease additional paid in capital because it's only 25. So they could reduce it to 0. But since there's not enough in additional paid in capital to offset the $50, then they just lower like retained earnings. So if retained earnings was 500, they just lower it to 475. They have to lower equity. I like doing this stuff. Is anybody else, or is it just me? So if there are no treasury stock gains in additional paid in capital, the losses upon issuance of treasury stock So if the company reissues treasury stock at a loss, the difference is debited to additional paid in capital. Okay, so it's debited to additional paid in capital, assuming there's enough money in additional paid in capital, and then I explain it down here. So if there are no treasury stock gains in additional paid in capital, the losses are a reduction of retained earnings. Lasker, thank you. Hello from Germany, Danke. I think that's the only thing in Germany now. Danke. So stock buybacks are a way for a company to reinvest in themselves. So when a company buys back its own stock, it's saying we have enough faith in our company that we're buying the shares. Because when a company buys its own stock, they're hoping the stock price goes up, because then it's a good investment. If it goes down, it's kind of a waste of money because they should have waited. And some investors prefer buybacks instead of dividends for tax purposes, because if you get $1,000 of dividends, right, you have to pay taxes. But if a company buys back their own stock and you had 25,000 of stock, and after the buyback, now you have $26,000 of stock. Your stock appreciated in value. That's generally what happens with a buyback. You don't have to pay taxes on that $1,000 because you don't have to sell the stock, right? So buybacks are good for taxes because you only pay taxes when you sell your shares, and only when you sell at a profit. So buybacks circumvent double taxation. So it's just a way for the company to give you money without forcing you to pay taxes. And especially if it's in a retirement account, then you don't have to worry about any taxes. So double taxation, it's just when a company pays dividends. Pretty much anytime a company pays dividends, like a regular company, like a Microsoft, it's always double taxed because the company pays taxes. You know, you have, you know, your revenue, your expenses. Say this is their income statement. So if their revenue for the quarter is $100, their expenses are $60. So their pre-tax income is $40, right? And say they have to pay $10 in taxes. So that means their net income is 30. And let's just say they give out 100% in dividends. So they so that's what they pay you, $30 if you own 100% of the company. But you have to pay taxes on the $30. So you don't get $30. You know, you get $30, and then after tax, it may be $21 if you paid 30% in taxes. So they pay taxes before they give the money to you, and then you pay tax on that money. It would be better if they didn't have to pay the taxes, right? If they didn't pay the taxes, then they would just give you 40 as your dividend. You still have to pay 70%, but after taxes, you have $28 instead of $21. It's a much better deal, right? And it's the same you know, the company still has the same revenue, expenses. It's just they're not paying taxes. I'm learning, never knew the accounting of buybacks. It's interesting. It's actually not that confusing, but I think understanding anything at a high level, it just makes things easier. It's kind of like you know, understanding how to like if you understand the basics on your car, like how to put windshield wiper fluid in or how to identify things. Just understanding at a high level makes things a lot better, so you don't get screwed over when you take your car into the mechanic and they say something. Oh yeah, you need a new Johnson rod. That's $2,500. So buybacks boost the stock price because less shares in the market, which makes the current shareholders more valuable per share. It's anti-dilutive. Buybacks also benefit executives at the company because most people at a company own shares. Some you know, CEOs own 10, 20% of the company, so it helps them. It increases your ROA, return on assets, because ROA is net income over assets. So say your net income is 100, your assets are 300. So your ROA is 33%. Okay. So before buyback, that's your ROA. And after buyback, net income doesn't change when you buy back stock. You still have the same revenue and expenses. But what happens to your assets when you buy back stock? It goes down, right? That's a Seinfeld reference. Because when you buy back stock, you have to your cash goes down. So say your cash goes down to 290. So now your return on assets is higher, 34% instead of 33%. So you're generating the same amount of net income with less assets. you generally want a high ROA because it implies, if it tells you how well you're using your assets to generate a profit. And if your assets are going down and you're still generating the same profit, that's a good thing. Or if your assets going up, but your net income is going up at a faster rate. Okay, it increases your EPS since there's less shares outstanding. So EPS, net income over shares. So your net income is $100, and you have 5,000 shares outstanding. So your earnings per share is 2 cents. Let's just do a little. Let's do a little higher. So your EPS is 17 cents. Net income 3,000 shares outstanding. So each shareholder gets 17 cents, or at least that's their stake in the company. But after you buy back, it's the same net income. Net income doesn't change. But let's say you're down to 2,800 shares. So you went from 17 cents per share to 18 cents per share because the $500 is spread over less shares. When a company sells shares, then cash goes up and owner's equity goes up. So that sometimes people say this a lot, like who don't understand stocks that well. They say, well, look at their cash. They have, $1 billion of cash. So they must be doing well as a company. But selling your company doesn't mean you're good at running a business. When you have a lot of cash because you keep diluting shareholders or taking on debt, it doesn't really make you great at running a business. You want to have a lot of cash from profits, not from just issuing stock. So it makes your balance sheet look good when you issue stock because it brings up your equity and cash. But when a company buys shares, then cash goes down and equity goes down. So you have to credit cash. To decrease cash, you credit it. You decrease additional paid in capital and retain earnings. So treasury stock is a contra equity account. It acts the opposite of a traditional equity account. A company can buy back stock in the open market for its current trading price. So mechanically, how do they buy back stock? Well, they can just buy it like we do in the open market. What's that term called when you buy shares in open market? When a company buys their own stock in open market? A market order? No. ATM. So if you ever see that, if you're ever reading like a company's like 8K, and they're talking about their buybacks, and they go, "Oh, we did an ATM offering of 100 million shares." ATM is the same as you buying the stock at the current market price. If you want to buy a share of a company stock and you just submit a market order, like what it's currently trading at. So you're going to, it will get executed right away, because whatever the stock is trading at is what you're buying it at. So that's ATM is at the market. So you don't have to like time it. Because if a stock is trading at $100 and you put an order in saying $95 buy, right? And if it goes from 100 to 180, you wouldn't get anything because you did a 95 buy. But if you did a market buy, you would buy it, say, at 100 or maybe even 101 if you missed that, or 102. But if it goes to 180, you benefit. Rigged is a term. What do you mean rigged? Alternatively, the company can submit a tender offer, which is when the company offers to buy its stock at a price higher. Because it's hard to buy $1 billion. No, in Apple's case, they bought 100 billion. So it's hard to buy $100 billion of your own stock. It takes a long time, and you have to find a lot of people willing to sell to you. So what you do is a tender offer. So if each share is trading at 120, Apple may do a tender offer saying, if you want to sell your shares back to us, we'll give you 125. It has to be at least above 120 because no one would sell it for below 120. And the reason that Apple just won't buy the stock in open market like we would is because once they start buying it, once they say they need to buy 100 billion. Say they bought 10 billion. The stock may go up like 20% just because they're buying so much stock back. And people are seeing this as a sign of this is good. They have a lot of money. So a tender offer is a way to kind of get around that. I'll be right back. 1 minute. Okay. Does it get annoying when I get on these tangents and just try to keep over explaining and analyzing? I don't know. I think a lot of companies take advantage of stock buybacks. Not all companies. That's true. I like the will be right backs. Yeah, some companies will take advantage and inflate their stock price. Lasker, that's 12 euros. That's much better than 12 US dollars. Thank you. It's crazy. They're almost identical, right? The euro and the US dollar. Actually, no. Yeah, a euro used to be like $1.30 US dollars, 1.3 US dollars for 1 euro. Now it's almost one. Oh wow. What about USD to CAD? So let's look at what JB. Well, Altria recently sold a large stake in InBev, then used the proceeds to buy back shares. The income they were getting from InBev was less than the amount they were paying. It's hard to like. Sometimes you look at like when a company buys back stock or acquires another company, and you try to analyze like, was it smart for them to acquire this company, or was it a bad decision? So the way I would think about it, and this is a totally simplistic way to do it, and you could think of this if you had your own small business. Exactly, NVR is a perfect example why stock buybacks are a good thing. So you can think of it like, pretend you have a small business, because it's a lot easier to kind of like visualize and understand things on a smaller scale. When you have these trillions of dollars and then you buy a company and there's so much going on. So let's just say you owned a grocery store, in your town. You live in a town of 25,000 people. You have a grocery store, and so revenue of 100,000, expenses of 70,000. So your profit is, and let's just pretend you don't get a salary. Your salary is whatever the profit is for the business. So that's your salary. So obviously you want more. We always want more. What town? Give me what city are you guys in? Or like, name a city, not a big city. Name like a city with like under 100,000 people, like 30, 40,000 people. Can anybody give me just in a city? It doesn't have to be the city you live in. It could be the city next to you, or it could be the city you live in, but it has to have under 100,000 people. Any ideas? Bentonville, perfect. So if you have your little grocery store in Bentonville, Arkansas, I'm just trying to show you a scenario, like how to like analyze whether an acquisition was good or not. So Bentonville, okay. What? A little flock. I thought it was Little Rock. Little flock. Okay. I know there is a Little Rock, the capital of Arkansas, where Bill Clinton is from, right? Little Rock. Let's say there's a grocery store in Little Flock, which is the next town over, because you don't want to open another grocery store in your town, because it's just not that many people to open a second. At least that's what your feeling is. So you find somebody who has a grocery store in Little Flock, like similar to yours, a small grocery store that helps the local residents when they need food. Let's just say same stats as you, 100K of revenue, 70,000 of expenses, 30,000 of profit. It just happens to be exactly the same. And everything is subjective. When you're looking at like these finances and numbers, but let's just pretend the person that obviously when you're buying this grocery store, you want to pay as little as possible, and the person selling it to you wants to sell it as high as possible. So let's say you talk to the guy who owned Little Flock grocery store, and you said, I'm interested in buying it, and he was getting older, so he's interested in selling it. So he's like, ask for $100,000. So you think it's a little high. You offer 50, and he takes it. So 50,000. So if it's 50,000, based on hit the profit, it takes 1.7 years to kind of to break even. So how do you it depends. Do you think that's a good return? It sounds like it's a good return. I take too long to explain things, I think. Okay. So if you were looking at if you were an investor, right, and you were looking at the financial statements for this company, say you wanted to get your friend or maybe your cousin to invest in your grocery store, and you tell him, look, I'm making $30,000 a year. Things are going okay. I've owned it for 5 years, but I want to grow. I want to buy another store. So you need $50,000 to buy this other store. So maybe you show your friend this situation. You say, look, that's my revenue, 100, expenses 70, profit 30. But consolidated, so if I do buy this other store, then my revenue would be $200,000, expenses of 140, and profit of 60. Do I know what company's in Bentonville? Give me a hint. Just give me the first letter. I know it's a popular company in Bentonville. I can't really. I know is it an oil and gas company? I know I've seen that before when I did a video. So that's what you kind of have to do. It's a little easier for this situation. So you would look at, this is before the acquisition. This was your revenue, expenses, and profit. This is after the acquisition. So you kind of have to put this together. So was it a good acquisition? Well, our revenue doubled, our expenses doubled, but our profits doubled. Walmart. Oh my God, I can't believe that's so obvious, because Sam Walton, he's from Arkansas, and his first store was in Bentonville. It's easier when you don't have a camera in your face and people looking at you. It's much more relaxing and easier to answer questions. Just so you know, I'm not that nervous, but like you could have a hard time thinking. If somebody goes, "What's your name?" That could be a hard question if you're in an extremely uncomfortable situation. Like if you're really, really nervous, you go on a job interview. And like, okay, so where did you grow up? And you're like, you can't like relax. But anyways, so this is kind of what you have to do. How do you know if an acquisition was good? You look at the financials before the acquisition. You look at the financials after the acquisition, and you also have to look at how much you paid. And the same thing is if you sold part of your business. You look at your sales before, like let's say we sold, we operated two grocery stores for a few years, and then we sold one of them. We sold the Little Flock one because maybe somebody was really interested who lived in Little Flock. So I guess this would be the before, the consolidated, before you sold it, and this would be the after. And then you would have to kind of. So that's kind of like what you have to do if you want to understand. Was it good to buy back stock? Was it good to acquire a company? You have to look at it before and after, which is hard to do, especially with a big company because there's so much going on. Bentonville. Altria sold a large InBev and used Altria InBev. Altria. So Altria announced its intent to sell a portion of Anheuser-Busch through a global secondary offering. Altria holds 197 million of AB InBev, so they own 10% of the company. They took a lot of losses, right, on that stock. I remember seeing yeah, Bentonville. So that should be the place we open our next business. Yeah, it's kind of like when a company buys, like when you're like invested in a stock and you find out they acquired this other company, you always think, oh, that's going to lead to a lot more sales and everything's going to be great, but it doesn't always turn out that way. Sometimes when you acquire another company, the companies don't kind of mesh well. There could be like tension, and it could make things worse. But if you own a stock, you just have to trust. You just have to trust that the board of directors is doing the best thing for the company. And if you don't feel that way, you just sell the stock. I mean, there's nothing you can really do if you don't like their decisions. sometimes you like some of the decisions, some decisions you don't like, and you get kind of annoyed because you still hold the stock. It's kind of like being in a relationship. It's like you like the things your spouse does, then other things you can't stand about your spouse. But you're not going to just divorce them because of the things you can't stand. So you just have to. What was that UK stock somebody mentioned? So is there any stock, any suggestions on a DCF to look at? Any ideas? Just throw out a ticker and we could just do a DCF and then look at the financials. Try to learn more about any company. So yeah, any ideas? You don't have to donate money unless you want to, of course. Well, not Burberry, but any stock but Burberry. I'm joking. I always do that. I always say, doesn't matter. There's no dumb questions. Everything's fine. And then the first thing someone says, like, no, that's not good. That's a bad idea. Yeah, Burberry. That's the British luxury good retailer. $3.2888. 888. That's a pretty cool. Wow, 7% yield. Burberry Group. They trade OTC in the US. .5%. Somebody wrote on one of my videos that this company has a PE of 8. The US stock is a PE of 8, but the stock on a German exchange has a PE of 14. Is that the person here who wrote that? Because that's impossible. You can't have a PE. And I understand why they thought that. But you can't. It has to be the same wherever you buy the stock, the PE. Even if the shares outstanding are different on different exchanges, everything gets adjusted. Bentonville, Arkansas. The pride of Arkansas. Does anybody invest on the London Stock Exchange? Isn't it weird that everything's in pence, not pounds? It makes it confusing. I wonder why they did that. Well, I think I know why. Because it used to be not many things were above £1. So it was easier to do pence. 311. It's all right, Burberry. So I'm at 1,100, a 19% discount. This is all in pounds. Or actually, the stock price is in pence, 888 pence. You must, Blade, you're not British, right? Yeah, I'm trying to think if I need to adjust anything. So Burberry is a British luxury fashion house. It designs and distributes trench coats, leather accessories, and footwear. They have Burberry's in the US. I've seen that before. Let's see. Oh, they're close to me. They're at 10 pounds. I'm at 11 pounds. See, they do pounds on Simply Wall Street, even though the stock is pence. Analyst estimate is also about 11 pounds. They pay a really good dividend, 82% payout ratio. So most of their earnings are dividends. So it was only 3%, and in 2023 it got higher. It must be the stock price came down. That's 95% of the time the dividend goes up is because stock price went down, not because they paid more in dividends. Because you can see dividend payments, they are paying a little more than they used to pay. So they pay twice a year. They didn't pay any in 2020. Burberry is the OTC stock. Yeah, they're OTC. Okay. So they haven't been, they have been trading. So since 2002, it's in 2002. So 1 year ago, it was triple. It was triple what it is today. Now it's trading at a 14-year low. It's trading at its 2010 levels. It's trading at 2010. 9% dividend. And the only reason it's trading at such a high yield is because of stock price. Because it was 2,500 pence. That's it. How do you? What's the sign for pence? So it went from 2,500 pence to 900 pence, and the dividend they pay twice: 42 pence and 11 pence. So let's just say 55 pence. That's an annual dividend. So yeah, so they've been paying around 55 pence a year in dividends, and the stock. So they're still paying the same dividend. It's just the stock price came down so much. So it went from 2.2% to 6.1%. Um, 2.2 to 6.1. You see 6.1? It happens to be exactly 6.1. That was good estimation. I'm just estimating. I'm not. And look at that, 2.2. Look how close my estimation was. But anyways, so it's not like they're paying more money. It's just the stock went down, which is 95% of the time you see a big jump in yield is because of the stock price, not because they're paying more. But it's just retail is just getting killed. It's just so hard for these companies to be, the long term is very questionable. A lot of these retailers, companies that operate in retail or manufacture products that sell to retail, it's just getting killed. But I would say it's probably could be a value trap. The thing is, if they don't go bankrupt, they probably won't. Where's the bottom? Because, like for instance, I'm sure a lot of people who invest in who were eyeing the stock when it was over 2,000. They thought, wow, 1,500 is a great entry point. And when it fell below 1,000, I'm sure a lot of people were like, this is too good to be true. Just like when Meta came down, a lot of stocks. But the thing is, what's the resistance? Look at our RSI 21. So it's extremely, according to RSI, it's an extremely good value. Because in March, when the stock peaked, the RSI was like 70, 80. The RSI, it wasn't in January, right in the beginning of the new year, it was also around 20. So if you got it, if you bought it in the new year, because right around here, when this dip, when it went from like 1,400, 1,200, the RSI came down to the 20s. So if you got in here, I'm sure you would have been really happy after just a few months. But now you'd be like, oh, God, I'm down like 30%. So this looks like a good entry point, because obviously that wasn't a resistance level. Let's see. It's back in. So the COVID bottom was it was 1,400. So I think a lot of people, when it hit the 1,400, I think that was a lot of people got into the stock, and that you could see that drove it up for a few months. I think candlesticks, you can maybe to tell better with a candlestick chart. I wish you could make these easy to read. Okay, so there was a big gap down right here. That was in June 26th, right when they paid the dividend. A pretty big gap down, because when a company pays dividends, the stock price does go down, but that's a real big gap. I mean, it shouldn't be going down from 960 to 900. I mean, it doesn't go down 7. Actually, no. It was, yeah, I guess it did go down 7%. That's the dividend. That actually makes sense mathematically. But when a company pays a dividend, like it will mathematically it will go down, but you may get a lot of new investors. Like when Meta paid a dividend for the first time, a lot of people who wanted to invest in Meta but didn't because they only invest in dividend stocks, a lot of people came into the stock. Do you own Burberry? No, I don't own Burberry. I'm not actually too familiar with the company. I think it's a value trap. It's really hard to predict this stuff, but the thing is, retail is getting killed, and I don't know when the bottom is. Like, it's just really hard to kind of predict the bottom. I think if you like the stock, I think buying it now, I wouldn't put that much money into it. Like if I had 10K to put into the stock, I would probably put like 2K in now. And then 2K every time it goes down 10%. I mean, there could be a run up that you miss, but I don't know. It's kind of like the people who right in the beginning of the new year, when it went from like 1,400 to 12, I'm sure some people bought it at that price, and then it went up. It went up like 10% in like a month, and the people bought it probably like, I should have put more money into it. I'm so stupid. I was gonna buy 10K, and I put 5K in. But now they're like, oh, thank God I didn't put all 10K in, because look at it now. It's 900. So what stock are we buying? Yeah, let's but it's a long-term game. Like a lot of people are looking for like a quick like a kind of like a flipping a house. They're trying to like flip stocks. They weren't buy and sell. They're not looking, like when I suggest stocks and it takes 5 years for them to grow, then no one's looking for that. Well, not no one, but most people are looking just to buy it, and if it goes up like 5-10%, then they sell it, which is not a good. You can't make money that way. It's just impossible. I mean, how many times can you get so lucky? Because if it's a good stock, it'll go up another 50, 60, 100%. Well, I never held a stock for 10 years just because I will, because like when I started making money to invest, it wasn't like I didn't have much money till I was like 30, because I wasn't really making that much, and then you have bills and stuff. So, but I plan to hold. There's a bunch of stocks I bought in 2017, like Meta, Berkshire Hathaway, Spiders. So I've held them for 7 years now. But so I do plan to hold a lot of those stocks. But the reason I didn't, like the stocks that I was holding for a long time, like 4, 5, 6, 7 years, when I started my business, I sold a lot of my stocks. so I could fund my business. And then in 2020, I sold a lot of my stocks to pay off my house. But if I didn't have to, like, if I didn't have these life changes, yeah, I would have held longer. Yeah, but I would, the intention would be to hold long term. I think go into it with the intention of holding a long time, 10, 20, 30 years. Of course, if there's things happen, you know, you have a terrible, like your spouse loses their job and you have to pay now a lot more bills. So, you know, things happen. Yeah, I have my A share. That's from 2017. What's going on? Yeah, in March 2017, I bought the A share for $260,000. So that's my best investment in terms of dollar amount. I made the most dollars in that, but percentage growth, I had better investments. So what other stock do you guys want to look at? Like, what's an idea? Did you freak out when the A shares? No, I mean, I'm not stupid. I mean, if the A shares went to zero, that means Apple went to zero. There was a glitch once too, where the A share, like when it was around 400,000, there was a glitch where somebody, I guess, bought one for 750,000. So it was up like 70% after market hours. But you knew that wasn't like a long-term thing. Baba? We did Baba yesterday. What's C-Box? Cake Box. PLC. 72 million? They pay a dividend. Huh. That's interesting. Box. C-Box. Cake Box. So it's a dessert place? Do they have like retail stores, like a bakery? $5 million, $6 million. Well, I'm at 149 pence. They're at 180 pence. So it's a little overvalued, but it's a really small company. It's hard to do Cake Box. Such a small market cap, but they pay a dividend, a 5% dividend. We could all get together and buy the company. It's a franchise. It's amazing such a small company pays dividend. Because you mentioned to a holding company that owns Stretch Lab, I went to a local Stretch Lab and got a good stretch in. Didn't sell me on the stock, but I did the stretching. Wow, that's cool. Yeah, I like it. What do you mean they didn't sell you on the stock? I mean, it's not public. It's not a public company. Oh, you mean sell you on the to buy a franchise? Is that what you mean? Yeah, I don't think the people there would even know anything about the franchise, like how much it cost or anything like that. Most people don't really know the business part of things that work there. One shop in 2008, 225 today. It is easier to grow and scale when you franchise, because then you have someone else spending the money to build that location and to staff it and things like that. Are they in the U.S.? Cakebox engages in the retail of fresh cream cakes in the UK. It offers cakes by celebration, cake design, seasonal wedding cakes. Oh, they also rent properties. So they buy the real estate and they rent it to the franchisee. No, the holding company that owns Stretch Lab is public. Oh, I didn't even know. Wow. Exponential Fitness, 784 million. Wow, a lot of growth, right? Exponential Fitness, Equinox. That's not the same thing, right? Oh, Tesla. I've heard of them. Exponential. Okay. Club Pilates, Cycle Bar, Stretch Lab, Row House. They own a lot of Stretch Lab. Wow, I'm glad you told me this. I didn't even know that their parent was public. Yeah. I don't even see an income statement. Is that possible? Yeah, consolidated statement of operations. Like here. Okay. Franchise revenue. Total revenue 79 million. Most of that is franchise revenue. 42 million. Merchandise. Franchise revenue. Did anybody ever hear of this company, Exponential Fitness? 785 million. I mean, it's a good business model, right? You charge people, franchisees, to operate your business, and they pay you a royalty. So it's kind of like all profit. It's you just need a few people to work at the corporate office to in case a franchisee has a question or for new potential franchisees. Yeah, the fitness sector, it's always going to be a tough industry. It probably goes through phases, but it's tough. Yeah, especially when COVID happened, like there was then people didn't see a need to go to a gym anymore. They could do it on Zoom, or they can do it on their own, but you can just do it on Zoom, take a class on Zoom, which probably costs you like $10. Well, if you go to the gym, you have to pay this monthly membership, and you have to drive there, and you gotta, get yourself prepared. Just so much easier doing it from home. I haven't worked on a gym, for a long time, like 20 years. When I was younger, in my 20s, I did, but I'd rather do it from home. A free tonal Stretch Lab from you. No, I signed up for Stretch Lab. Well, the reason I found out about it was I was looking at franchises. I always look at businesses. So I was looking at franchises, and I thought it was an interesting concept. So I went to my local Stretch Lab, and I joined. It's expensive. It's not cheap. But when you see such growing revenue, I mean, obviously growing revenue is really good. Like it tripled. But it's like in that example earlier. So like if you had this grocery store and you made $30,000 a profit, and you wanted to open a second grocery store, so you found the town over, the guy who owns the grocery store, he has the same numbers as you. So you give him $50,000 for his store. And if his store has $30,000 of profit, it's great because in 2 years you already got your money back, right? But what if you open his store? Like what if you take over his store, and then you realize you have to pay somebody. You didn't even think about it. Like it's so obvious, right? But because you run this store in Bentonville, so you don't have to pay anybody to run it. You run it, most of the time it's open. You just have staff to help. And then you open this store and you're like, shit, I can't run both of them at the same time. And it's hard to find full-timers for like a low price. So you find somebody who could run it, and the cheapest you could find is $40,000. So you paid $50,000 and you're losing $10,000 every year. So it wasn't a good acquisition. Unless you could somehow grow the revenue or lower the expenses. But it's kind of like this, like just because revenue went up, like in our example, you went from 100,000 revenue, one store, to 200,000 revenue. So if you showed somebody your income statement, you go, wow, I doubled my revenue. But you're actually doing much worse because you doubled your revenue, but your profit went down. You went from 30,000 to 20,000. And of course, there's more liability, more risk. You could lose more money, or so growing revenue doesn't mean you're doing better. And it doesn't mean, and even in this situation, even if you double your revenue and your profit went down, that doesn't mean it's terrible, because that could be the first year you're operating, and then the second year it may look like you have economies of scale, so you could start buying more product for cheaper. So now you buy double the stuff, and your expenses go down because you get better deals. And then your second year, you went from 20,000, you doubled your profit. So I mean, yeah, obviously it's not just 1 year you have to look at the stuff, but you have to kind of look at the whole picture. I'm gonna say whether to claim it's expensive. It's really expensive, right? Mine is 30 minutes from my house. That's far away. They definitely helped me through sitting at a desk all day. It's like $80 an hour for a stretch, so it's not cheap. United Healthcare. So revenue tripled, and their net income, it was negative, now it's positive. So that looks good. United Healthcare. Well, what, you never said it before. I asked if anybody wanted to see a ticker, and you never said anything. You should have said it earlier when I was asking. I'm joking. I know you said it earlier. I was just trying to be funny. 488, 449. A really low whack. Tesla looks like a good value right now. It's it went up like 20% in June. So I'm at 629. They're trading at 488. What do you mean they own medical insurance? I mean, they're one of the brokers, right? They're not the only option in town. I don't go through United Healthcare. I have Kaiser. Look at that, 1 star. That's what happens when you, first off, your medical records are in the Philippines. When you do call them prepared for over a minute of automated. Worst company, the Kmart of One Healthcare. And yeah, insurance is a pretty good industry. It's I don't know. I own Berkshire Hathaway, which is big on insurance. Yeah, they're definitely vertically integrated. Yeah, those reviews. That happens with a lot of companies. People complain a lot. But it seems like everybody's complaining with this company. That it's not like one or two complaints. 100% of the reviews were complaints. It's the world's 11th largest company by revenue and the largest healthcare company by revenue. Yeah, I know they're always been ranked like one of the top. Kaiser. Kaiser is the best. The United Health Group is fourth. Is this just California? Kaiser is the largest health insurance company in the U.S., followed by Blue Cross Blue Shield. Well, some of the health insurance are household names. Others might seem obscure to the average consumer. That's crazy. Kaiser's the largest? How could that be? I didn't think Kaiser was that big. I thought it was just a good size, not. See, the difference between Kaiser and United Health is United Health is just a broker. Kaiser is an actual hospital. Because you. It's Kaiser. I've heard of. Did I search the wrong thing? Kaiser is the largest health insurance company in the world, followed by, well, some of these, but there's a list of 50 large health insurance by U.S. and deeper. What did I do wrong? Like, why does it say Kaiser's number one? Kaiser serves members in 8 states and DC. Because they're only in 8 states, Kaiser, not even every state. Kaiser is an integrated health that includes both healthcare providers and insurance coverage. The company specializes in care model. Anthem, yeah. United Health, Affordable Care Act, marketplace coverage to individuals and families. They're only in 18 states. United Health offers individual insurance, employer, Medicare, Medicaid. So United Healthcare is like a broker. They have partnerships with medical providers and 6,500 hospitals. So there's no like hospital called United Healthcare. But there is, like, I go to Kaiser Hospital or Kaiser Medical Office. So it's an actual, they actually treat people at Kaiser. United Healthcare is a broker. So it's a different kind of business model. Elden Ring? Maybe this, I'm searching something. So this is different. That's why it gets confusing. People look at stocks and they search stocks with the best PE. and then they on one site, it's one website is different than another website. Okay. I'm gonna start streaming video games. That's more fun than stocks. Market percent, largest health insurance companies. United is number one at 16%. Anthem, Blue Cross Blue Shield, 10%. Kaiser, 9%. Humana, CVS. Oh, Aetna. Oh, this is by revenue. Okay, so this is the same data. United is the largest in terms of revenue because they generated $215 billion of revenue, but they have less members. You see, they have 4.8 million enrollments. Anthem is 5.3 million. And Kaiser's 8.8 million. So Kaiser has many more people enrolled than United, but much lower revenue. I would think it would be the opposite. But it's good to like do this kind of like types of due diligence. It helps you understand the market better. I just want to get like, even if you think you understand things, sometimes when you do digging into it, you realize you actually don't understand it that well. You ever have that? Sometimes I have that. Like I think I understand how companies make money, and then I learn more about it, and I'm like, actually, no, that's not how they make money. Because I think it's important when you invest in a stock, or if you wanted to buy your own business, it's important to understand how the business makes money. That's why every time I do a video, I always show you how they generate revenue. Like for instance, like Boeing. You would think it makes its money by selling aircrafts. But like I'm just kind of making up numbers. I know these are not. Say it has 100 billion of aircraft revenue by selling planes, $100 billion. But it only makes 1% profit on that. Where it makes all their money is servicing. So they have these servicing contracts with like airlines and other companies who use their aircraft. And when they buy a Boeing, they have to also sign a contract for Boeing to service every year. Boeing will come out and service the plane because you need someone to service it. It's kind of like, you can't just find someone. Oh, can't Google, I'm looking for somebody to service my Boeing aircraft. Like, it's such a specialized thing. So you have to they sign these contracts, like these 5, 10, 20-year contracts with these companies, and they charge them like maybe, $25,000 a month, like a recurring revenue thing. And then they can always, every year they'll go out there and make sure the plane is, or if they have, if Delta has a problem, they can just call Boeing and say, something's going wrong with the plane, come out and fix it. So this is where they make all their money. like for servicing. And it's selling doors. But I'll give you an example of something that you probably are familiar with. So say a company, Brother Printer, they make printers, and okay. So let's just say they sell $1 billion in printers for the year. And it costs them like $1 billion to make those printers. Well, let's go a step further. Let's say they lose money every printer. I know they don't, but let's just say every time they sell a printer, they lose money. Because printing companies don't really make much money from selling printers. They make all the money from selling toner. Because if you buy a printer for like $400, that's only one time. But then over the next 6 years, you spend like $2,000 in toner. And it's so cheap to make toner. Like to make the printers, it's much more expensive and time consuming. To make the toner is very, very easy. And it's recurring. You constantly sell toner. So that's what I'm saying. Like it's good to understand how companies make money, because sometimes it's not what you think. Boeing isn't great at servicing their planes. Well, that may be true too, but they make a lot of money. Is Boeing too big to fail? Yeah, I think they're too big to fail. That's probably a good example of someone. But I don't understand why Kaiser has more members. Kaiser. Well, Kaiser doesn't offer dental and vision. United does, because United doesn't actually. There's no doctors at United that help you. It's just an insurance broker. Kaiser, they sell their own insurance. They don't sell anybody else's insurance. United, you can, but only Kaiser sells Kaiser insurance. You can't go to United Healthcare and get Kaiser insurance. You could go to United Healthcare and pretty much get any other insurance, but not Kaiser. Are you familiar with Kaiser? Is everybody familiar with Kaiser? I'm just assuming United Healthcare offers health insurance to 50 million members in every state. The company is also heavily invested in innovation technology. They focus upon offering health plans for many kinds of people in various stages of life. Kaiser focuses on managed healthcare insurance plans that mostly utilize their network of. So they only sell. Is that the term managed care? Maybe that's a term that I have to look up. Managed care versus. Okay, so it's traditional health insurance allows you to select your healthcare provider, such as your favorite doctor or hospital. You may have to pay for services when rendered, then submit a bill. Managed care combines the delivery and financing of healthcare services, has gained acceptance over the years. It may restrict you. So if you buy traditional health insurance, you have access to this insurance policy, and you pick whatever doctor you want, as long as they're within, they're in that plan. But managed healthcare is you kind of have to pick. You have to pick the doctors within that program. Like you can't pick any doctor in your town. Delivery and financing healthcare product has acceptance. It may restrict your chance to, but in return, you typically pay less for medical compared to traditional coverage. The managed care network will control and direct access. So it's more limiting. HMO, health maintenance organization. It's so confusing, healthcare. That's why you need these brokers. HMO pays a monthly amount, which gives them access to a wide range of healthcare services. Recent regulatory changes have provided HMOs the opportunity to offer plans with deductibles and coinsurance similar to PPOs. HMO members often have little or no paperwork. EPO, exclusive, an insurance company contracts with hospitals or specific providers. And then there's PPO. PPO offers another kind of provider network to meet the healthcare needs of consumers. Traditional insurance carriers and insurance contract. Consumers usually choose who will provide their insurance, but pay less in coinsurance. Point of service plans. Does anybody have health insurance like Kaiser, like similar? I've never heard of anything like Kaiser. I never heard of a company doing this until I moved to California. I always thought insurance, you just buy insurance and then just go to any doctor within your network. But with Kaiser, it's its own network of doctors. But there's so many. It's not like it's that limiting. There's so many doctors and hospitals in Kaiser network. It's definitely a scam. It's so expensive. The thing is, if you go to is it called urgent care? If you go to urgent care, if you go to a hospital in an emergency, like, oh, I broke my arm, or like, a hospital can't deny you, right? They can't say, wait, we got to check your medical, make sure you're insured. They have to take you, and then they charge you after the fact. So people who don't have medical insurance, they just go to urgent care, no matter what, even if it's a cold, they go to urgent care, and they say, this is emergency. My stomach hurts. It's emergency, and they can't turn you away. And then they send you a bill. You just don't pay it. So you don't pay the bill. All these people who don't have medical insurance, they use the emergency room, and then they get a bill. They ignore it. But that means the people who pay insurance are really paying for it. So that's just another thing that drives the prices up. There's so many other things, but like, it just. Alex, you don't live in the U.S.? You didn't know that? The only reason I know this, I didn't know this, and then I was in my, I did like a focus group somewhere, and I was talking to a doctor, and he was explaining this to me. I didn't know this. I didn't know you can just walk into a hospital, and he was explaining this to me. He's like, all the people who don't have insurance, the reason insurance is so expensive, because I was talking to him about it, said because anybody can just walk in. Like if you're homeless, you just walk in and say it's emergency, and legally they can't turn you away. I mean, I think they can kick you out at some point. Like you can't overstay your welcome. Like if they treated you and you just want to stay there because it's too cold outside, you have nowhere to live, they could kick you out, but they can't deny you medical insurance, medical help, just because you don't have any money. Hospitals can also refuse to treat patients with emergency medical care when the patient appears to be seeking treatment. Okay, so I guess if you're obviously trying to defraud them, like if you're really sick or injured, they can't deny you. But if they think you're lying to them, like in this case, they said if people who are looking to obtain drugs, they can deny you, which makes sense. Like you can't say, I'm suffering, I have cancer, I need opioids because of my cancer. Patients behave dangerously, destructively while waiting for medical treatment. Yeah, I mean, if they're really, like, they could kick you out if you're like threatening other people. But as long as you're kind of a normal person with an obvious Kaiser is the best health insurance company among those available in healthcare. It's the largest private nonprofit healthcare. Yeah, no, ML Williams. Yes. That's why I think it's amazing what Kaiser did. Because I remember when I used medical in New York, I always just thought everything is so confusing and difficult and overpriced. And then when I got to California, use Kaiser, like everything's connected. Every single doctor is connected together. They can every doctor could log on, and I never have to like send a bill in. I never have to, everything is just like automated. If I go to one doctor, another doctor knows. If I go to one doctor and need prescription, like everything is just so streamlined and it works perfectly. So if Kaiser took over the world, it would be the best medical because they're doing it perfectly. I thought you said you're not going to Costco. Where, Scotty's? Oh, yeah. Give me like 3 hours. Excuse me? How long? But if I buy deli meat at Scotty's, it might not last a whole week. I guess in an hour or less. Wait, no. Okay, half hour. I guess that makes sense now because Kaiser is a lot cheaper than regular medical insurance. Because Kaiser is limiting, you can only go to Kaiser doctors, even though there's a lot of them. But when you have regular medical insurance, you can go to any doctor, and there might be some amazing doctors within every network. There's always going to be doctors probably aren't great. So Kaiser has like 8 million members. Kaiser has 8.8. Revenue is 215 billion. It's a lot of zeros, right? And Kaiser is 126 billion. But the thing is, Kaiser, it's so much cheaper. Oh no, what am I saying? I did it backwards. Okay. So Kaiser, the revenue per member is $14,000. So the average person who belongs to Kaiser, like me, spends $14,000 a year. And the average person who belongs to United Healthcare spends $44,000 a year. This just shows you how inefficient. It's the same country, United States. It's not like one's in like Brazil and one's in the United States. It's the same exact country, but Kaiser, if you're United Healthcare, you pay triple for services. Kaiser Soze. Yeah, that was a great movie. Anthem is really expensive too. Anthem is much cheaper than United Healthcare, but not as cheap as Kaiser. Kaiser is a nonprofit organization. Consortium of for-profit and not-for-profit. Each medical group operates as a separate for-profit partnership. I thought I just read it said nonprofit. Is one of the largest not-for-profit organizations. KFHP. Kaiser is American Integrated Managed Care Consortium based in the United States. The Kaiser Foundation Health Plan and its regional operating subsidiaries, Kaiser Foundation Hospitals and the regional Kaiser. It only has an operation in 8 states. It has only 39 hospitals and 700 medical offices. Each Permanente Medical Group operates as separate for-profit. The multiple affiliated nonprofit registered. What's the biggest nonprofit? What's the biggest nonprofit? Feeding America. revenue of $4.3 billion. It's a big nonprofit, right? That Feeding America is the biggest nonprofit in the U.S. United Way is third. Salvation Army is sixth. Okay, I think I kind of beat this dead horse, right? Wait, what other stock? Did anybody have any other stocks that I missed? Oh, Anthem. I thought Anthem was a... Anthem is private? Anthem. Anthem is listed in trades. Anthem is not. I thought. Anthem. Elevance. That's Anthem. Elevance. It was named Anthem. So Elevance is the. So Elevance is the parent. Subsidiaries is Anthem, Blue Cross Blue Shield. It's confusing, right? Trying to keep track of these things. 123 billion market cap. Look at insurance. You can make a lot of money with insurance. Look how hard it is. Don't forget to watch that YouTube video, Growing Hatred for Financial YouTubers. Actually, we're getting our cabinets redone in the house. I have to actually help my wife with that. So, Growing Hatred for Financial YouTubers. I hope I'm not mentioned. There's no chance of me being mentioned. Okay, well, yeah, thanks for joining. It was a fun stream today and yesterday. I'll see you guys next week. Yeah, and email me if you ever want me to send you the information I covered. Just email me. In the description of the video is my email. I might respond. I'll probably respond. Okay, I'll talk to you later. See ya. Thanks.